I'm Mike Camerlander, president of the Greater San Marcos Partnership, and this is the 13th edition of this event hosted by the Greater San Marcos Partnership. And we've always strived to share a program that provides a complete perspective on the challenges and opportunities of the current economic environment from national, state, regional, and local perspectives. Today will be no different as we welcome a keynote speaker who will bring his vast experience from his time at the Federal Reserve and now as faculty at the University of Texas, San Antonio. And we will wrap up our program with a panel of regional real estate professionals who will share their outlooks on the development landscape across the Austin-San Antonio corridor. Now on to the program. To introduce our keynote speaker, please welcome John Shavy with Frost Bank to the stage.
Wow, this is a tremendous crowd for San Marcos, so thank y'all for coming out today and welcome to our economic discussion. Frost is super excited to be today's sponsor. My name is John Shavy, and I have the privilege to serve as the market president for Frost Bank here in the Austin market. I oversee our commercial lending operations for the Austin area, and I'm also oversee our commercial banking operations for Hays County. Frost has been a supporter of the GSMP since day one, and we're honored to do so. I'm also honored to have personally served as a board member and a past chair. Prior to introducing today's keynote speaker, I'd like to take a minute to share a little bit about Frost Bank. We've been helping clients in the state of Texas for over 155 years, and today we're one of the 50th largest banks in the United States. So hard to believe over the 23 years I've been with the bank, we've really grown in the right way. Frost serves a wide variety of banking, investments, and insurance services to our businesses and individuals across Texas, and we serve the Austin-San Antonio corridor, Houston, Dallas, Fort Worth, Corpus Christi, Rio Grande Valley, and the Permian Basin markets. So for the most part, we cover the state of Texas. I'd like to say Frost is large enough to compete with the large mega banks, but still small enough to provide that personal touch and customer service that our customers deserve and expect. We are very bullish on the Central Texas market. There's a lot of good going on here. Y'all might have heard we recently announced that we are going to be expanding our Austin market footprint from 17 branches to 34 in a period of 24 to 36 months. I am happy to say that Hays County is going to be the recipient of some of that growth. So more announcements to come very soon, and we're going to be excited to be opening some new branches in Hays County. That said, if you're not already a Frost customer, we would love the opportunity to sit down with you and understand your personal banking and your business banking needs. And for those of you that are Frost Bank customers, thank you. We appreciate the business. Enough about Frost. I'm here to introduce our keynote speaker. In previous years, we've brought a national economist who delivers a keynote addressing the economy from a national perspective. This year is no exception. The GSMP is excited to introduce a gentleman who has been dialed in on economic matters since joining the Federal Reserve Bank in Dallas in January of 1984. In his most recent position, he served as Assistant Vice President and Senior Economist until his retirement in February of 2022. I'd like to invite Dr. Keith Phillips to the stage. During his 38 years at the Dallas Fed, Phillips regularly participated in policy briefings to the bank president in the preparation for FOMC meetings. He was also co-editor of the Southwest Economy and the Dallas Fed Economics and participated in the Federal Reserve System projects such as the Beige Book Working Group. Dr. Phillips has published numerous articles in economic topics in the Dallas Fed publications and academic journals. Research Papers in Economics, which tracks publications in economics, ranks Phillips in the top 5% of economists across the world in terms of the number of distinct publications he's made. Over the past 18 years, he has been the most accurate forecaster for Texas job growth in the Western Blue Chip Economic Forecast. We look forward to hearing what he has to say about the state and the national outlook for 2024. Please welcome Dr. Keith Phillips.
Well, thank you for inviting me here today. You may think, well, they didn't get a good one this year. They got some retired Fed guy, but it's the only way a Fed guy can talk is if he's retired right now, because they're meeting today in D.C., as you know. And when I worked at the Fed to talk, during the week prior and a couple days after the FOMC meeting. So I think you all know what's going to happen today, right? What's the Fed going to do? Nothing, right? So there's a 96% chance that the Fed will not change rates at the meeting today. We'll see how that works out. But anyway, I usually talk for an hour. So my challenge today is get through this in 20 minutes. And economists, and I'm no exception, love to show data. Data makes us feel like we know something. They say the definition of an economist is someone who's good with numbers, but doesn't have the personality to be an accountant. So, well, you like that one. So I'll try to squeeze one more in. So we use a lot of data to try to figure out kind of not just where we're headed, but where we're at, because sometimes that's even hard to figure out. And it reminds me of a story of two economists who were hiking out in Big Bend. And they had been hiking all day, and they realized they're not quite sure where they're at. They're getting a little concerned they might be lost. So one of the economists tells the other guy, hey, could you figure out where we're at? So he takes out a map, and he's looking at the map, and he takes out a compass, and he's looking at the compass. Finally, he takes out his GPS, he's looking at that. Another guy said, well, after looking at all of the data, where are we at? He said, well, you see that mountain over there? He said, yeah. Well, according to this data, that's where we're at. So anyway, we'll see if we can figure out where we're at. And as I said, I have a lot of slides. But to tell you up front, what I'm going to say is, you know, after the GDP came out last for the nation, it was quite healthy, 3.3% in the fourth quarter, after 4.9% in the third quarter. After the second quarter came out positive, a lot of economists and analysts had shifted from a recession scenario to a soft landing scenario in the U.S. I myself still believe there will be a mild recession in the U.S. sometime in the first half of this year. Traditional indicators suggest that. But given household finances, they're still fairly good shape, even though they're deteriorating. I think it's going to be mild and short-lived. In Texas, we will not see any downturn. Job growth and GDP will continue positive, although slower this year than last year. And there's numerous reasons for that. One is, you know, we've been doing so well. Since the beginning of COVID, Texas has grown 3 times faster than the nation as a whole. Some of the long-term factors such as low cost of living, low cost of doing business, more flexible labor markets, those types of things helped us throughout this period of COVID and will continue to help us in the future. And then you kick in the extra, that oil prices have been quite stable above break even for the oil and gas sector, which affects a lot of industries, even in Austin. A lot of high-tech equipment goes into drilling. A lot of other equipment goes into drilling. And so overall, Texas will avoid this mild downturn. And of course, if we narrow it down to the Austin-San Antonio corridor, it's one of the fastest growing regions in the nation, the fastest, Hays County, as you know, the fastest growing county above 100,000 population over the last decade. It'll be continued growth here, although I think it'll be a slowing pattern like we're seeing all over the country, at least for the first half of this year. Okay, so now you can go to sleep if you'd like, because that's what I'm going to tell you. I'm just going to try to back it up a little with some slides. So I don't know if your kids would think of this. Can you see that? It's hard to see. That's a pumpkin with the inverted yield curve. And that's been the scariest pumpkin for Halloween over the last 2 years. Back in 2022, when the yield curve first inverted in the second half, is when everyone thought there was going to be a recession coming in 2023. And because it didn't happen in the first half of the year, they thought, and didn't happen in the second half, well, then there's not going to be a recession. There's going to be a soft landing. But the fact is, if you looked at and I'll get into this a little bit later, but if you look into the yield curve closely, its lead time is on average about 17 months. The recession doesn't happen right away. It happens, and it's hard to believe that something could predict so far in advance, but there's reasons for why it does. All right, so once again, despite market expectations in general of a soft landing, I think a recession is still likely. The yield curve is a key basis for my thoughts, but I also look at kind of other reasons and other signs, and I think most of it is in household financial situation. That households have had a lot of excess savings because of COVID stimulus, and that savings is winding down. We had a surprisingly good holiday spending season, which has prompted the main factor for the strong GDP growth last year was continued strong consumer spending. But I think we're going to see a sharp slowing in consumer spending in the first half of this year. And I can tell you this, that if you're sitting next in June or July of this year and you don't see any signs that we're in a recession, don't cuss me out yet, or don't say what an idiot yet, because it takes the NBR dating committee who tells us when a recession occurred, on average about 12 months, and it might be longer this time, because data gets revised and all kinds of data lags and everything else. So we may not know for a long time, but I think the nation is significantly going to slow in the first half of this year. Inflation has subsided significantly, and I think it's excited more than people realize. Of course, everybody's inflation rate is different, but the broad measures of inflation, the way we can measure it, have really kind of subsided, and there was some tick up in December, but if you kind of smooth out the data, you can see, and the most relevant thing I see is that core PCE, the personal consumption expenditures deflator, is a broader measure of overall inflation than the CPI. And the core PCE has averaged 2%, has actually been 2%, was 2% in the third quarter and fourth quarter of last year. That's the Fed's goal, is 2% inflation. So if you look at year-over-year numbers, that smooths out the data, but also takes into account what happened, a long time ago. So I look either month to month is volatile. So if you look at quarter to quarter, we've seen some significant improvement close to what the Fed's goal is. But the Fed's kind of hung interest rates pretty high, and I think it's kind of too late. They say the Fed policy impacts are long and variable, at least on average about 11 months. So the Fed changes rates. It's not going to do it now, say the March meeting, which is about 50-50 chance, or the May meeting. That's going to affect the economy 11 months from then. So, Fed, we're experiencing now what the Fed did, a year ago in terms of its impact on the economy. Anyway, and the Fed's kind of been reluctant to lower rates. Long term, they expect a kind of equilibrium Fed funds rate to be about 2.5%. We're way above that, 5.25 to 5.5. So rates are high, and they're not going to fall very quickly, at least in the first half of this year. And so it seems to me that inflation is going to come down, I think, continue to come down quicker than the Fed thinks, but they're already behind the curve on that. So if you look at job gains, we had a kind of a tick up in December, but these are monthly job gains, number of jobs created monthly, and I have to watch, holy cow. If you look at the quarterly data, you see a really significant slowdown in job creation. GDP was up strongly in the second half of last year, but a lot of it was this consumer spending that was maintained, I think, a lot by this excess money given out during COVID stimulus. Plus, government spending was strong, and that also is state and local government got a lot of money, COVID money, and is still spending that money. and then a buildup of inventories counts as increased investment. So I think all these things are likely to slow sharply in the first half of this year. Headline inflation continues to narrow. I have both CPI and PCE on here. CPI is the blue and the personal consumption expenditures deflators in red. You can see on the monthly basis it's kind of volatile. You can see it's slowing. On a quarterly basis it's more visible. This is core measures where they exclude food and energy, and once again it's been 2% for the past 2 quarters. So indicators of financial, the household financial situation suggests that this strong consumer spending won't be held up in the first half of this year. This is a thing the San Francisco Fed does, and you can, they have it updated every month on their website. This is through November of last year. And it's the excess accumulated savings due to pandemic support payments from the government, and then how they, households have drawn that down. And they've been drawing it down quite a bit. So of the 2.1 trillion accumulated excess savings, 1.9 trillion has been spent. And if you look at kind of the average they spent of that accumulated savings households over the last 4 months, it means that they'll run out of this excess savings in the first quarter of this year. Credit card delinquencies are on the rise, the highest they've been since the first quarter of 2012, meaning that households are starting to feel some financial stress. Another indication that consumer spending will slow sharply in the first half of this year. So if I look at the outlook, this is the thing that I was on the pumpkin. It's a yield spread. I like to look at the 10-year, 1-year spread. And you can see from this chart, this data is never revised. And that's the greatest attribute of, one of the greatest attributes of it, is that what you see on this chart is what you actually saw at the time. Not like a lot of different indicators get revised over and over. This is actually what you see. And this goes all the way back to the 50s. And you can see every, you know, you don't see the recessions. That's a shame. I see them. But this thing is inverted, gone negative prior to every recession, with one false signal in the 60s. But the average lead time, that's the numbers up here, between when the thing went negative and when the recession started is 17 months. So the most recent inversion occurred in July of 2022. 17 months later puts us at January of this year. That's when the yield curve said the recession would start on average. I think it may be sometime in the first half of this year. You can see in the Great Recession of 2008-9, the yield curve inverted 19 months before the recession started. Okay, why does the yield curve inversion predict the recession? First off, it's all the players in the bond market's expectations about what's going to happen to interest rates. And interest rates, if you think that a recession is coming, what's a good strategy? What happens in a recession is rates fall. So you lock in the secure, you buy it, you load up on 10-year treasuries at the current rate if you think rates fall. That's a good investment. So if a recession is going to happen, people buy 10-year treasuries, and when they do, the price goes up, the yield goes down. Okay? It's also a measure that from the bond market that the Fed is over tightening. As short rates are going up, long rates go down, you see an inversion. So that does it. And then once you get an inversion and long rate, how do banks make money? They make money off the yield curve. They fall short and lend long. And if long rates are lower than short rates, guess what? You can't make a lot of money lending at that spread. So it creates a credit crunch, and we're seeing those signs. So the yield curve is not just some sunspot theory. There's a reasoning behind why it leads. And I still think it's going to lead. A lot of people don't believe it, like, oh, it's not going to work this time. And that's what they say every time. Every time there's a reason why the yield curve is not going to work. The Great Recession, it was because globalized financial markets. Like, oh, it doesn't mean the same because, you know, U.S. treasuries are in a global financial system, blah, blah, blah. And so that's why the inversion isn't going to be followed by a recession. So every time it inverts, there's a reason why it's not going to work this time. But it almost always works, so I'm going to stick with that. I'm a simple guy. Okay, so what we got here? I got to speed up. The Fed thinks that GDP growth, the Fed puts out forecasts. So if you're interested in what the Fed thinks, you can go look for the Survey of Economic Projections. They do it once a quarter, and then they did it in December, and they expect GDP to be 1.4%. That's generally this year, fourth quarter over fourth quarter, that's generally consistent with a soft landing, but could also mean it declines quite sharply in the first half and increases sharply in the second half. So they're not going to give you a quarterly forecast, but a fourth quarter over fourth quarter. They expect the Fed funds rate to finish the year at 4.6. That's still quite high, 4.6%, although somewhat lower than they projected at December, September meetings. So I'm not the only one predicting recession. The Conference Board, who puts out the U.S. leading index, also expects a shallow recession in the first half of this year nationally. Okay, so the U.S. economy is likely to slow. Call it soft landing. I think it's more going to be a recession in terms of jobs being negative and GDP being negative, but it's going to be shallow and sharp. Texas economy, what's happening in the Texas economy? The bottom line on Texas is that we're going to slow, but we're still going to be stronger than the nation, and we're still going to avoid a recession. Over the pandemic, Texas, as I said, has seen job growth almost 3 times the national average, 8.5% versus 3%. You look at the most recent year, last year, Texas jobs grew 3.1%. Versus 1.7% in the nation. Texas was by far the fastest growing state of the large states last year. Of all states, it was behind only Nevada, South Dakota, Idaho, and Wyoming. Those are just like rural counties in Texas, those states. Okay, so Texas doing very well. Why is Texas doing so well? Well, you probably know, but high oil prices, and I can show you a chart that might convince you of this. It's hard to believe a lot of places that oil prices still impact Texas relative growth because we have so much going on besides the oil and gas sector, but the oil and gas sector is still important to the state. Net immigration from other states during COVID was very strong. In fact, it increased. So people moved here where they could have more affordable housing and could live in suburbs and stay away from other people. And we benefited from that. High tech benefited from COVID initially. They're adjusting to that now, but obviously it's hard to believe that prior to COVID, most people didn't know what Zoom was. Now we know what Zoom is. Anyway, we have a much more flexible labor market. We have a lot less rules about labor, so when demand for labor goes up and down, wages can adjust appropriately unless the overall demand for labor doesn't change as much. It doesn't get out of balance, I should say. All these things help us in the long run and have helped us over the last year. Our job growth did slow last year, but still remained positive. In our surveys, the Dallas Fed surveys, it's not our surveys, I don't work there anymore, but the survey suggests that we'll see positive but slowing growth. The Texas Leading Index, which I created while I was at the Dallas Fed, suggests that also. We have a slightly higher unemployment rate. You might think that means that we're weaker, but it actually means we're stronger. One of the reasons why we're able to grow faster is we have more labor availability, and in times of tightness, you want to very, very low unemployment rate can constrict your overall job growth. Once again, we're growing faster than the nation. We've been slowing over the past 3 years in terms of job growth, but remained above the nation. Long-term, Texas job growth is about 1 percentage point faster. We average about 2% in the nation, about 1%. Texas, if you look across industries, I'm getting really close to the end. If you look across industries, Texas last year was faster in every private sector industry. So that shows it wasn't just one sector that was the issue, it was these long-term factors such as low cost of living and doing business. All the metros last year grew faster than the national average, pretty consistent across the large metropolitan areas. If you look at key sectors, manufacturing and services have weakened. This is from the Dallas Fed survey, and actually the January data came out yesterday and Monday, and we saw a slight downturn in services, revenue, and manufacturing production in January. The housing market, they're going to talk about after me, but with these high mortgage, first the housing prices increased, and then the mortgage rates increased, and people got used to 3% mortgages, so 7.4 is quite a challenge to the home building industry. At first, we saw a pickup in permits in Texas because no one in existing homes wanted to sell their house and get rid of the 3% mortgage. But even the permits of new building are beginning to flatten. This rise in home prices and mortgage rates have reduced home affordability, another challenge for the housing sector. And Texas is seeing rates of affordability they've never seen this low. But of course, relative to other areas of the country, we're still more affordable, but everyone's seen it with these price increases and high mortgage rates. Another challenge is office vacancies remain high. They flattened out after rising. You can see Austin here, the orange line, is about where it was during the 2008-2009 recession. Overall, they remain high, but have flattened out, and one reason is still a third of the workers in Texas are working remotely, according to our surveys. Prior to the COVID, it was about 8.3%. Now it's about 32%. Oil prices remain above break even, which according to our survey done last year was about $62 to drill a new well. And they're above that. And while the rig count has flattened out somewhat, natural gas and crude oil production in the state continue to increase. Okay, so I look at this area as what it is if it was already a metroplex. And if you look at growth over the last 2 decades, the Austin-San Antonio metroplex grew about 73% in terms of jobs. Dallas-Fort Worth grew about 52%, Houston and the state about 47%, the U.S. 18%. So it's just phenomenal growth here in this region. And I expect this to continue. I don't see anything that's going to stop it. We all know that Hays County, for counties above 100,000 residents, experienced the fastest population growth from 2010 to 20, 53%. Comal County, which isn't far away from here, is 49%, was second fastest. So this region had 2 of the fastest growing in the whole country. Caldwell County, which is is more rural with less population of less than 100,000, grew 20%. Which is about the same as the state as a whole, and the nation grew only 9.7% in population. So we're seeing a lot of growth. And then if you look at just the last 2 years, that was over the decade of the 2010-20, Hays is up 10.4% over these 2 years. 2022 is the latest data. We don't have 2023 yet. And Caldwell was 4.3%. So still continuing to grow fast, continue to grow much faster than the nation. So there's I see this area as Dallas, like Dallas-Fort Worth grew, right? I grew up, my first start at the Dallas Fed was in Dallas. I lived in Grapevine. I got 2 minutes. And I see that growing the same. And the initial growth occurs in between the 2 cities along the main corridor. So we see that here in Hays, and as it gets expensive here, then it goes to the outer lying counties. And then, so I think Caldwell has its years of fast growth still to come as the growth spreads out. Where the growth occurs, a lot of it will be about, things that you already know about. More affordable housing, good schools, public infrastructure, and low crime. Texas State, obviously, a big part of this growth in the innovation corridor. Okay, so I got 2 minutes. This is one of the slides I love. This is real oil price, and this is Texas job growth relative to the nation. Whenever oil spikes up or down, you see our relative growth change. This is a really cool chart. And actually, since the fracking started in the mid-2000s, about 2004, this relationship has actually gotten closer. And if oil prices hang up above break even, we're almost assured to grow faster than the nation. Texas banks have tightened credit standards. Loan volume is declining across the state. New orders are declining, all suggesting slower growth. And this is the leading index projecting slower growth, particularly in the first half, and then a pickup in the second half. So in the summary, the U.S. likely to see a mild recession. Consumer finances are weakening. Recession likely to be mild and short-lived. Texas doing much better than the U.S. because of long-term factors and the energy sector doing well. I think we're going to grow about 1.5% to 2.5% job growth in Texas this year. And the U.S. will grow somewhere between 0 and about 1.5 because it'll decline in the first half and pick up in the second half. This corridor is likely to see continued positive growth. The biggest challenge will be handling that growth, keeping housing prices affordable, keeping crime rates low, continue to improve the schools. And that's all I have to say about that. All right, thank you.
Thank you again, Dr. Phillips. I'm going to invite our panelists up on stage now, and I'll introduce them all while we do that. Our first panelist is Steve Welton with J.E. Dunn. Steve is an experienced professional with a rich construction background, graduated with a dual degrees in construction management and architectural engineering from the Milwaukee School of Engineering. Steve has over 26 years of experience within the construction industry, including in Milwaukee, Chicago, Nashville, Florida, and most notably, Austin. Steve's tenure at J.E. Dunn has been progressive evolution, starting from field operations and culminating in his current role as director of pre-construction, serving as an advocate, driving projects from conception to execution. Welcome. Our second panelist is John Colglazer with Partners San Antonio. John joined Colglazer Properties in 1996 and has specialized in the sale and leasing of industrial manufacturing and distribution products. Among John's accolades include being honored by the San Antonio Business Journal for completing the largest industrial lease of 2004 for his representation of Valero Energy Corporation to open its first self-distribution facility, initiation into the SIOR on its fast-track program by exceeding sales volume requirements, and a number of other projects he has been involved in and now is very heavily involved in the San Marcos and Caldwell County area. For his career, John has completed sale or lease transactions in excess of $500 million. And our final panelist is Brooks Willig with La Tierra Realty. Brooks is managing partner with La Tierra, an Austin-based land development and investment and development firm. Over the course of his career, Brooks and his team have acquired, developed, and sold over 10,000 acres in Central and South Texas with uses spanning housing, industrial, and farm and ranch. La Tierra is particularly active in Caldwell County, with 10 active projects representing over 1,200 acres for future development, with most recent being Real Cold Facility in Lockhart. Please welcome these gentlemen to the stage. Thank you all for being here. Let's start with Steve. How long have you each been working here in the greater San Marcos region, and why do you think this is the best place in Texas for investment?
Excellent, thank you. J.E. Dunn has been in Central Texas for almost 19 years now. I personally have been with J.E. Dunn here in Central Texas for 17 years. As to why invest in this area, I think Mr. Phillips did a pretty tremendous job of explaining that. I didn't bring any pie charts or graphs with me to help support that. But at the end of the day, it's pretty obvious that there's a lot of growth, not only in this community, but in the major cities surrounding it, right? And with all the people that are coming to Central Texas, obviously the facilities that support that need to grow. And with the major projects, and I'm sure we're going to talk about here tonight or today, those major projects that you guys know about that are happening in Austin and plan to be coming in both San Antonio and Austin need supporting facilities, and this is the perfect hub to help support that. So there's a lot of growth opportunities, a lot of development that's planned, and that's going to be coming to Central Texas.
Yes, I've been in the real estate business in Texas, Central Texas, for it'll be 28 years in May, and throughout that time, I've focused in the industrial sector with bulk distribution and manufacturing, all of which are San Marcos has really become a focal point, more so now than ever. I think I sat here and did this presentation previously, and I think at that time it really was talking more on the speculative side of why San Marcos would probably be in the path of growth, or it's likely to be just because of where it sits geographically. Well, we're here now. That time has come, and instead of talking about speculative developments and where my company partners and the clients we represent, the partners we have, are going to be developing projects because we think we're going to get in the path of growth. We're now dealing with actual projects that are bringing real employment and significant investment, and companies that are exciting, that are international companies that are seeing it. And I think the biggest driving force, it's quite simply put, you've got a very supportive community and the surrounding counties, but geographically, if you look at it, it's State Highway 130 has become such a major artery for the industrial world, taking the pressure off of 35. But you look at it, it's strategically located about halfway between Highway 130 and 35, and it fronts on 35, and it's halfway between San Antonio and Austin, with quick access to the border and on one of the legs of what we'd call the Texas Triangle, obviously going from San Antonio, Austin, Dallas, Houston, and then back to San Antonio. So it really is at the heart of the melon. And from both a speculative standpoint and a real-time activity standpoint, I don't know of a better place to be. Certainly within the state, but I think you could make a pretty solid argument for within the nation.
Better? There we go. Last time I had a microphone, I was doing karaoke, so I'm kind of learning and practicing. I've been here in this business for only the last 7 years. My partners have been doing this a lot longer. And John, I think what you said is very well stated. I think in this area, you have such an interesting combination of access, developability, political climate, educated population, that all make this a very compelling place to do business and to invest.
Great, thank you. Brooks, we're going to stay with you. How different is your job today than, say, even just 2 years ago? Dr. Phillips said a lot about how much the economy has changed, but each of you, your jobs and what you deal with every day has changed a lot in the last 2 years as well.
Absolutely, it's changed a lot. I would say 2 years ago, as a seller of land, things have changed a lot. I mean, 2 years ago, there were a lot of potential buyers in the market who maybe were investing or had theses that were kind of limited to there might be someone who's going to come along later and be able to pay more money for this thing. That in the last 2 years has definitely changed. As money's become tighter, the number of kind of true or active or real buyers in the market has certainly shifted. I do think that plays well for this specific area, in that, kind of in line with some of the stuff that we just talked about, there are a lot of real companies, industries, and just general needs that have to be in this area relative to others in the country. I think that that change in kind of who buyers are in the market is a national macro one, and I think makes it a more broadly tighter market that plays into Central Texas's hand. as a buyer of land and other real estate investment opportunities, over the last 2 years, it's definitely changed in that we're not competing with a bunch of other buyers for deals. I mean, the days of getting outbid at the last minute to try to acquire a project have certainly changed. So it's kind of a two-sided coin. And I think where we're at now is that, again, it's a tighter market with a little bit less activity, but the folks who are left are the ones who really want to and need to deploy capital. And I think this is a great area to be positioned in for those buyers.
The shift, when I look back at 2 years ago, construction hasn't faced the work from home issue, right? I mean, they never really had the opportunity to work from home. You got to build in the field. So where our shift has really happened over the last 2 years has just been in market sector, right? The larger commercial work that's been happening downtown and other places has slowed because construction lending has slowed. Interest rates are higher. So the shift has gone more to the municipal markets, right? There's a lot of municipalities that need the improvements, that have the approved capital and are spending that. So that's been a big shift for us. And then looking forward to supporting other future work, there's a large industrial sector that is going to be coming, and then life sciences, some other markets that are coming to Austin. It's happening, and that shift in market sector and focus is really what's transitioned over the last couple of years.
Well, obviously, in our business, the financial and lending conditions have changed drastically. That doesn't mean the projects aren't getting done. They're much more challenging. But a lot of what we do has shifted, and as I sit and address y'all in this room, it's probably more exciting from your standpoint that it's more of a user-based business kind of cycle that we're in right now, which means real jobs. We sat here 2 years ago. It was who could get the best site to get speculative land, to get speculative development up, to get it in the, as I said in my initial remarks, in the path of development. We're working more directly with users coming to the region, bringing jobs, bringing significant capital investment, and honestly, at numbers that are staggering that you just wouldn't believe the amount of investment, because it is, and it's directly tied to the nearshoring. I think we are close enough. It's a unique position of still being in close enough proximity to the border and all that's going on there. Being able to touch Austin and the tech market, San Antonio, the labor market, it's nearly ideally situated. So it's really been more of a pivot. The difference too is we're seeing strong tenant demand still, and from a leasing standpoint, and that usually, having done this for 28 years, I've seen some downturns, and usually you see the evaporation of tenant demand, and that's when it gets pretty scary in our business, and that has held up for the most part. It's not at the feverish pitch that we were experiencing during COVID, but that also, that's following, the fact that y'all are all back out in the community doing things normally, not ordering everything at home. So I think that's to be expected. But what we're seeing in the region, as I initially said, it's a totally different aspect. It's international companies, and they're very laser focused here in this immediate area. In fact, I've got some meetings tomorrow with an international company that would come to the region, bring a lot of jobs, a lot of capital investment.
And just to add on to that, I think that's very well said, that it's a user-driven market today. And I think it's interesting or worth noting, in thinking about how my work is different from 2 years ago, those users, the things that are important to them are pretty different than speculative investors or developers. And one of the key critical factors for these users, John, I'm curious for your take on this, but in my experience, is time. And time for them means availability of utilities and speed to get things entitled, turning dirt, and really moving. That the importance of that to the buyers in the market now, I think is pretty different from 2 years ago, and again, I think is a big competitive advantage for this region relative to other options available to those same users who are looking on statewide or national search.
I couldn't agree more. Those are the key factors. It's speed to market. It's people don't realize that 1 month of production for a lot of these companies equates to dollars that are just unfathomable. Power is a major concern, both from a manufacturing standpoint. We're seeing a lot of data center activity in the community. That doesn't necessarily drive a lot of jobs, but the capital investment that comes along with that is pretty staggering. But power is an issue and then the entitlement process, which these surrounding counties here are very good about expediting the entitlement process, because companies are quick to move on if they feel like things are bogging down. And because, as I said, time is money, and it's a lot more money than a lot of people realize, because of the contracts these companies have with the different major manufacturers. Just getting operational 1 month, 2 months, 3 months sooner, it's meaningful. And the help that we see from the different agencies and government entities is really, really helpful here in Central Texas.
So Hayes and Caldwell counties are both in the Austin MSA, and a lot of you, I know, John, you're in San Antonio, but you guys are generally more in the Austin area. Are we seeing more coming up from the south than we have in the past in the San Antonio region? Are more companies looking towards out of San Antonio? I know our biggest influx of people into Hayes and Caldwell counties traditionally has been Travis County people. Are we seeing that same movement from Bexar County? And I know from an economic development standpoint, and we have our friends from Greater SATX and OA in the back of the room, we're working better with our corridor on economic development. Do you see it as a strength for us moving forward as we continue to do better at our job of working together on that?
I would tell you unequivocally the biggest difference that I've seen is the cooperation between those organizations, between y'all, between Opportunity Austin, between Greater San Antonio. And it is bearing fruits directly, that the regional approach, that let's just get them in the region, and the rising tide will raise all ships. And I have not seen this level of cooperation and collaboration in my career. And so, yes, I do. I think it's only the beginning of it. And working, and I actually am the industrial partner for partners in San Antonio and Austin. So I'm all up and down the corridor, extending north of San Antonio. But I can tell you that the cooperation right now is why we're winning. It's why we're winning deals. It's why we're on the radar. It's why we're on the radar screen. It's why of all the aforementioned, successes that are just starting to happen, and there's more coming.
Yeah, and I would just echo what you said before. It's all about that speed, right? And that cooperation is coming in the form of providing a quicker avenue to being able to turn the dirt. But it's also accessibility to infrastructure, right? We all know there's a water problem, but being able to have easy access to power and water and infrastructure just to the site without really having a significant spend on improving that is really where the site selection is coming into real importance. And I think a continued dedication to improving that infrastructure is really going to help bring in even more.
So building on what Dr. Phillips talked about earlier in the program, what are each one of you most looking forward to? What are you excited about in 2024 for your industry, and what can we look forward to this year from each of you?
I would start with kind of an anecdotal piece on that. As you look at a lot of that data, and as I tell a lot of my junior guys, it's be cognizant of the news and the macro environment, but worry about what's on your desk in front of you. And if your desk stays full, then you're okay. And I feel like that Central Texas's desk is full right now, and it's going to stay that way for a while. We're seeing it on the front lines. We're seeing the interest level come in. I think there's going to be some big announcements. I could tell you if 20% of the projects we're working on right now were to come to fruition, we're going to have a record year from just our standpoint. I would hope that our success rate would be higher than that, but it's different. I mean, it's things have like we said, it's user based, but those really honestly those are going to be the things that y'all are going to notice out in the community. You're going to notice big companies coming in, and these big companies tend to cluster because it's a proven ground. When you have the cooperation of the different economic development entities with the municipalities, the power companies, when they see that, they're like, okay, they're going there. They tend to follow one another. And I think that's what you can look forward to more than anything in the next 24, 36 months. But definitely building a big head of steam this month. And, Texas is doing well.
Again, I would second a bunch of that. I think what I'm excited to see in 2024 is some of these bigger announcement projects kind of getting over the lip of the cup. And to your point, I think that can create some real critical mass and drive even more interest, particularly in this. Sorry, I'm kind of cutting out maybe, particularly in this very user-based market. And so I think, again, the 2024 position, if these or when these announcements can really drive further activity from users who might not even be, but we'll see that coming.
When I look forward to 2024, a couple of things. One, we've all been talking about the growth and the development is going to continue to happen, right? The markets have shifted from, I know what Austin's been seeing for the last several years. But at the end of the day, we track cost indexes on a quarterly basis. And for the last 5 quarters, construction pricing has really remained flat. Commodities are fluctuating up and down a little bit here and there, depending on the quarter that you're in. Labor prices are going to continue to grow at a steady pace. There continues to be a significant skilled worker shortage for construction. So I know there's a lot of programs in and around Austin, Texas State, different neighboring communities on really training and having workforce development programs because we need to get more workers into the skilled trades to help support all of this growth, right? But even though that's on the increase, overall pricing remains flat. And we're anticipating that throughout 24, the backlog of work is going to continue to diminish. We need to get some of these projects started. But we're hopeful that there'll be more aggressive pricing in terms of margins from the community to help secure that work, secure that backlog. So we're very bullish on the pricing of things and making sure that that not only continues to remain steady, but goes down.
Great. Anything, last parting words for the crowd?
I think, honestly, I would say just keep your foot on the gas here and keep doing what you're doing. I think there's a lot more to come. I think we wouldn't be here. We were invited to speak here because we've bought into the community, and just keep doing what you're doing.
Long Central Texas, for sure.
Well, thank you. I will say, from the GSMP standpoint, we're working with all of you on projects constantly. Mentioned Real Cold in Caldwell County. Brooks, you're obviously in that epicenter of what we believe is the growth corridor here for the partnership between 35 and 130. So thank you all for your time today. Thank you all for attending this Economic Outlook. Please be on the lookout for the Transportation Summit that we partner with the San Marcos Area Chamber on February 20th. Get your tickets for that. And with that, thank you for coming. Thank you, Dr. Phillips, for your talk. And we look forward to seeing you at the next Greater San Marcos Partnership event. Thank you.